welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's a look at the stories for the day. The ongoing Russia-Ukraine war has cast a shadow over the G20 event too. The absence of a joint communiqué after two high-level ministerial events attests to the presence of this elephant in the room. India, meanwhile, has remained persistent in its appeal for a multilateral approach to tackling global socio-economic issues. So what are the major takeaways from the G20 meets so far? Here's Devarga Sanyal's report.
We must all acknowledge that multilateralism is in crisis today.
While addressing the G20 foreign ministers meeting on March 2nd, Prime Minister Narendra Modi went on to say that multilateralism is in a crisis. Ironically, the theme of the G20 presidency is One Earth, One Family, One Future. The G20 foreign ministers meeting was unable to agree to a joint communiqué. Neither did the finance ministers meeting held a few days before. India, as G20 president, issued a chair's summary in both the tracks. But sharp differences emerged on both the occasions around the Russia-Ukraine war. In the finance minister and central bank governor's track, the group said that it will take action to enable enhanced financing for sustainable development goals, including and beyond climate, in line with the G20 Sustainable Finance Roadmap. The group also asked the Financial Stability Board's recommendations for the supervision and regulation of stable coins and crypto assets by their third meeting in 2023. The most crucial progress was made towards addressing debt vulnerabilities in lower and middle income countries.
India's basic objective was to have a solution beyond the debt servicing sustainability initiative, and this involves the low-income countries and some of the lower middle-income countries as well. And basically, it was to get some kind of commitment from the finance ministers. And in that endeavor, India has succeeded. Basically, China is, of course, I think perhaps the largest lender to Sri Lanka and to Pakistan both. So it will have to agree to the other members of the G20. Only then the IMF would feel secure. But the COVID crisis and the rising figures of unemployment have made countries inward looking and have resulted in the raising of barriers to trade. So this is what I think will be the next challenge.
The G20 foreign ministers meeting was divided into two sessions, covering various topics such as multilateralism, food and energy security, development cooperation, counterterrorism, global skill mapping, humanitarian assistance and disaster response, and women-led development. However, the Ukraine war proved to be a major roadblock in building consensus.
Unlike, for example, in Bali, there has been a problem with maintaining the kind of consensus which was achieved there. That consensus has not survived, essentially because while the Western countries have, in fact, increased the level of pressure on Russia and to some extent China, this time we have found greater resistance. And I think the Indian effort has been to say, yes, we have this issue that we have to deal with, but that should not mean that we should neglect other major challenges, such as, say, climate change, or the whole issue of, how do we revive growth in the global economy.
Despite the clear polarization amongst member nations, experts believe the G20 meetings so far have not only strengthened India's role as a neutral player invested in the economic needs of the global south, but also highlighted its thriving digital economy and the skill development ecosystem, thus painting a positive image of the country.
With no end in sight to the Russia-Ukraine war, Western economies are trying hard to avert a recession. India too is facing the consequences. FDI equity inflow into the country has dropped by 15% in April-December FY23. So what is going wrong with India's FDI story? And what is the road ahead? Tushar Verma has the answer.
FDI equity inflow in India has been on a decline for the last couple of years. From April to December in FY22, the total FDI equity inflow was about $43 billion. In the same period in FY23, it fell to $37 billion. This is a decrease of almost 15% year on year. The fall was prominent in three sectors: automobiles, computer software and hardware, and infrastructure construction. The combined FDI equity inflow of these three sectors in April to December in FY22 was $17.73 billion. For the same period in FY23, it reduced to $10.56 billion. This is a 40% drop. The computer software and hardware sector saw a drop of 21.3% from $10.25 billion to $8.07 billion. So, what are the reasons behind the drop in FDI in this sector?
What tends to happen with FDI is that it tends to be, especially for us as a country, it tends to be quite lumpy in that you have a few large cases that tend to dominate the broader FDI numbers. My sense is that the number of cases is probably about the same, but there are a few lumpy cases that are missing this year. Computer software and hardware, hardware has just never been, unfortunately, that popular as an FDI sector for India. And I think with the PLI scheme, hopefully we'll see some of that start to change.
The automobile sector has perhaps seen the largest drop in equity FDI. The fall is from almost $6 billion to $1.27 billion. This is a drop of nearly 80%. So, what are the reasons?
Automobile sector of India is one sector fairly integrated with the global supply chain, and some amount of car produced in India are also exported outside. Now, with the global uncertainty and its impact, particularly on the advanced economy, is that although we have not seen much slowdown in the growth so far as US is concerned, but certainly we are witnessing or going to witness a fair amount of slowdown in the European economies. And these two are one of the largest destinations for Indian auto component manufacturers. And maybe that is one of the reasons why the FDI inflow into the auto sector has also been impacted.
Although equity FDI inflow has fallen in automobile and computer software and hardware sectors, their share in the total FDI equity has remained the same. From April to December in FY22, the combined share of the two sectors in equity FDI inflow was 20%. The share has remained the same for the same period in FY23. What does the coming financial year hold for the two crucial sectors of the Indian economy? Will there be any increase in FDI inflows?
The scenario in fiscal year 24 will be slightly better than the FDI inflow for the fiscal year 23. Our estimate is that the net FDI inflow into India would be somewhere in the vicinity of $64 to $65 billion.
Although FDI flow into India has declined, the situation may change in the days to come. Several multinational companies are looking for options beyond China, and India has been trying to woo them. Foxconn, which is setting up manufacturing facilities in Karnataka, is one such example. Manufacturing has not been India's strong suit, but with the help of policies such as PLI, along with cheap and accessible labor, India may be able to turn the story around.
But the multiple headwinds have failed to deter the domestic mutual funds whose faith in Indian equity markets remained intact all through fiscal 2022-23. Their inflows have crossed the 1.5 trillion rupees mark for a second straight financial year. But will they be able to strike a hat-trick? Our next report takes a deep dive.
Domestic mutual funds have been acting as a strong counterforce against foreign portfolio investors or FPIs selling off Indian equities. For the second consecutive financial year, net flow in equities by MFs has crossed the 1.5 trillion rupees mark. Analysts believe this strong show is likely to continue in the next fiscal year as well. Between April 1, 2022 and March 1, 2023, mutual funds pumped in a net 1.53 trillion rupees in equities, according to data provided by market regulator SEBI. This comes after they pumped around 1.72 trillion rupees in equities in FY22. In comparison, FPIs have withdrawn roughly 36,538 crore rupees in the equity segment so far in FY23. This, however, is better than the net outflow of 1.42 trillion rupees, which was recorded in FY22, NSDL data shows. According to Swarup Mohanty of Mirae Asset, the strong inflows are a reflection of India's strong economic growth.
I think two major data points which are driving this positiveness of the market. First being the data points of India definitely stand out. I mean, when you look at power consumption to four-wheeler consumption via, say, GST collections, the data points are there for everybody to see, and that gives the confidence to Indian investors. And secondly is the great change that has come about in the sentiments or the behavior of the Indian retail investor towards Indian equity markets. I mean, look at 13,000 odd crores going into the markets in the form of SIP every month. That changes the structure of the Indian equity market, and that is what is giving a lot of comfort to the market on the downside.
Data 2 backs Mohanty's analysis. Except in FY21, mutual funds have been net buyers in equities since FY15. In the past 9 financial years, between FY15 and FY23, MFs have pumped in nearly 6.9 trillion rupees in Indian equities. So, how does the road ahead in FY24 look like?
2024 will be a little different. I mean, I come from the fact that there could be a possible slowdown of the Indian economy towards the end of the financial year 2024. And to the fact that investors or the first-time investors who came into the markets over the last 1.5, 2 years have not been making money from the market. And thirdly, the data points that are coming out from the rest of the world are not exactly strong. The world today is in a very fragile state of affairs, and any time these data points could definitely create a fair amount of disturbance in the market. We see a blip of it now and then, so this will start playing on people's mind as these data points progress. So I suspect towards the second half of financial year 2024, we might see a little bit of a slowdown from investor inflow into equity markets.
Outlook for FPI flows too remains conservative for 2023. According to Kunal Vora of BNP Paribas, FII holdings in the Indian market are close to the lowest in a decade. With China reopening and India's elevated valuation premium, we see a risk of FII outflows continuing in 2023. That said, India's sharp focus on capital expenditure and a resilient economic momentum won't be able to keep it off investors' radar for long. On Tuesday, the markets will remain closed on account of Holi.
Former RBI Governor Raghuram Rajan has claimed that India is dangerously close to the Hindu rate of growth due to subdued private sector investment, high interest rates and slowing global growth. But what exactly is a Hindu rate of growth? We decode it for you in this segment.
The Hindu rate of growth is a term used to describe India's low rate of economic growth for a prolonged period. It is generally used to show that the country is satisfied with the slow growth rate. The term was first used by the late economist Raj Krishna in 1978 to refer to the low rate of economic growth in the pre-liberalization era. Krishna explained it against the backdrop of socialist economic policies. He also used to teach at the Delhi School of Economics. It must be noted that the slow growth rate is called the Hindu rate of growth only if it is persistent and is accompanied by low per capita GDP with population growth factored in. The most recent example of this is the 1980s, just before P.V. Narasimha Rao's economic reforms. India's annual population growth rate was over 2% and the per capita GDP growth rate with 3.5% GDP growth was a meager 1%. According to Krishna, this was due to the socialist policies of state control and import substitution. It is also said that in one of his lectures, Krishna said that no matter what happens to the economy, the trend growth rate in India will be 3.5%. That changed when liberalization, privatization, and globalization reforms were initiated in 1991 when India faced a balance of payments crisis. According to reports, several economists believed that the term Hindu was used to link the belief in karma and bhagya with the slow growth. However, later economists and historians like Paul Bjarek rejected this connection and instead attributed the low growth rate to then government's protectionist and interventionist policies.
I will achieve, I will fly high. FDI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The former RBI governor, however, praised the growth in the services sector. He called it the bright spot, while asserting that most developed economies are largely service economies. Well, that's all we have for you today. For more news and analysis, please log in to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.